Hello there, Mr. Mash here. Welcome back to Macroeconomics 1. In this section, we are going to focus on the monetary sector. And what I will do with the monetary sector, I'm going to split it into 3 parts. In the first part, which is this part, we're going to talk about money. So stick around and then you get to understand what is money, where did it come from. In the second part, I'm going to talk about financial intermediaries and central banks, the role of central banks. And in the final part, I'm going to discuss the John Keynes liquidity preference theory, demand for money, and changes in the money market equilibrium. All right, so let's get right into it. What is money? What is money? You have to understand that there was a time when human beings did not have money, but still they traded. During that period, the trade that happened was referred to as barter trade. So barter trade is when people exchange goods and services for goods and services. For instance, you have grain, but you want meat. You are going to swap your grain for a goat. Let's say you're going to take 1 sack of grain and you swap it with 1 goat. This is what is referred to as barter trade. The exchange of goods and services for goods and services was referred to as barter trade. Or for instance, you don't have the grain, but you have your power. You go and work for this person and you get a goat. That is also referred to as barter trade. For any form of trade to happen, there has to be what is referred to as a double coincidence of ones. For any trade to occur, there has to be what is referred to as a double coincidence of ones. What this basically means, double coincidence. Someone wants what you have, and you have what they want. You have grain, you want a goat. But this person with the goats must want the grain for trade to take place. Otherwise, if the person who has goats does not want your grain, this trade is not going to take place. You need to look for another person that has goats. All right. This made trade very difficult. So it was very inefficient. And time consuming. It was costly. Because of these reasons, people started to think of other ways to make trade more efficient. And soon after barter trade, people decided to trade using what they refer to as commodity money. They decided to trade using what they called commodity money. So commodity money is when you use commodities to purchase certain goods and services, right? This actually brings me to the definition of what money is. Money is defined as anything that is generally acceptable. It has to be generally acceptable as a means of payment for goods and services. So it's generally acceptable for payment of goods and services or for debt. In this instance, things like grain, which is a commodity, grain, livestock like cattle, or even seashells, for example, cowries, which were used somewhere in India. These were examples of commodities that were used to purchase goods and services. So these were generally acceptable. As means of payment. So these were actually money, according to the definition of money. But there were challenges. There were challenges with using commodity money, right? For instance, grain can be attacked by weevils. Cattle does not last forever. It can die. The seashells are not all the same. Some shells look nicer than others. Some are bigger, some are smaller, so they are not uniform. Hence, for money to perform its functions as money, it must have certain characteristics. Let's quickly look at the characteristics of money. So it must have certain attributes which we refer to as the characteristics of money. Okay. Money has to be durable. Remember, we said the grain could be attacked by weevils, the cows could die. Money has to be durable. It must be easy to carry around. Money has to be portable. It must be easy to carry around. It's not easy to carry around tons of grain, like what happens during the time of Joseph. There's that story in the Bible where Joseph's brothers sold him to slave traders. He went to Egypt, and long story short, after some time, there was a famine in Israel. They had to travel all the way to Egypt, and grain at that time was generally acceptable as a means of payment for goods and services. But grain was not easy to carry around. Hence, his brothers and his family ended up relocating to Egypt, which is how Egyptians ended up in slavery in Egypt. Which is how Israelites ended up as slaves in. It's a very interesting story there in the Bible. You should check it out. But anyway, money has to be durable, money has to be portable, money should also be uniform. We said all of these things are not necessarily uniform, they can differ. All these things are not necessarily uniform, they can differ. And money also, it has to be divisible. It has to be divisible. You should be able to break it down into smaller units. Because of this, the king of Lydia in 600 BC minted the first coins. So they made a decision to say, no, the commodity money is not working for us. Let's deal with coins. So the king of Lydia minted the first coins in 600 BC, after which coins became quite popular in China in 770 BC. These coins were now being minted by a variety of countries, but this is where it started, in Lydia and then in China. Okay. These coins were minted either using silver, gold, copper, etc. Right. But the problem with this is that these metals, if it's a lot of coins, they are heavy, which means they are not portable. They are heavy. They are not portable. Right. And the reason they used these metals were actually precious metals, quite costly. Gold up to today is quite costly. And hence, back in the day, money had what they refer to as intrinsic value. The value of the money was actually derived from the coins that were used to make the money. But because of these metals being rare, and also because of them being heavy, if you have to carry a lot of them, then people then moved on to make paper money. Paper money as we know it today does not have intrinsic value. There's no the paper, there's nothing precious about the paper used to make money. It does not have intrinsic value, it just has security features. The value of money comes from confidence. So this is referred to as fiat money. The value of this fiat money comes from confidence. Me accepting a note is because I'm confident that the next person is going to accept that money. And that confidence is built from the issuing authority, which is the central bank, our focal area in the next session. If I'm confident that the next person is going to accept this money, I'll accept it and then easily transact using that money. So that money is, once that confidence in the issuing authority goes away, it's a disaster. That money loses its value, and it loses the value fast. All right, so that's how money is evolved, and that's how we have the money we have today. And this money performs four main functions. The functions of money include one, the most basic and the one that you know is money as a medium of exchange. Okay, Money as a medium of exchange means that money is used to buy goods and services. This is buying. Money is used to buy. Number 2, money as a unit of account. Money as a unit of account. What this means is that money is used to state the value of goods and services. You know that a pen is going to cost you 20 rand. That's a unit of account. You know that with 20 rands you can buy $1. That's a unit of account. Money is a unit of account. Money is also a store of value and a store of wealth. These are very related. Store of wealth usually happens over a long period of time, but store of value, if you keep your 20 rand today, instead of you buying bread with that money, you can keep that money and buy the bread next week. So the money has stored the value of bread for you, but this is usually affected by inflation. We are going to discuss inflation much later on, not now, but just take note that the value, money, the function of money as a store of value is affected by inflation. All right. So these are the 4 main functions of money, and money is going to be broadly defined in 3 categories by the issuing authority, the central bank. So there are 3 broad categories in which money is defined. These are the measures of money. These are the measures of money. There is the M1 money. This is the most liquid form of money. It's the coins and notes plus demand deposits. This is the most liquid form of money that people easily have access to. That's M1. Your M2 money is a broader definition of money, which includes the M1, notes, coins, demand deposits, plus short and medium term money. Short and medium term deposits. And the most comprehensive definition of money, which focuses on the function of money as a store of value, is the M3 money. M3 money includes M2. Remember, M2 also includes M1, so it includes everything. It's M2 plus all the long-term deposits. All the long-term deposits. These are the 3 measures of money. This is how money is defined by a central bank, right? Basically, you must also understand this. This is it from my side in this first part on the monetary sector. I'll see you again in the next section where we discuss financial intermediaries, but in the meantime, enjoy economics.